Welcome to The Strategic Investor. Join us as we interview some of the world's most productive asset managers and uncover sophisticated and unique investment strategies in the markets. Here is your host, Charlie Wright.
Hello and welcome to Strategic Investor Radio on OC Talk Radio, where we bring you investment strategies you are not hearing elsewhere. We'd like to welcome today, for the very first time, Dr. Mira Farka, economics professor and at Cal State Fullerton, well-known speaker throughout Southern California on current economic conditions. Dr. Mira, welcome to Strategic Investor Radio. Very pleased to have you.
Thank you, Charlie. It's a pleasure to be here.
So, Dr. Mira, a little of your background here. You arrived in the USA from Albania at age 17 with two crisp $100 bills to your name here. You went to Cal State Sacramento, then to Columbia for a master's and then a PhD in economics. Started at Deutsche Bank. That's back when they could pay their bills. You've been at Cal State Fullerton now for many years. You're a dynamic presenter, because I know that because I've seen you, and I was recommended to attend your presentation by a CPA who actually got excited about it and who said, you've got to come here. This lady, she is dynamic and fun and funny, and you were everything and more, and it was all about current economic conditions and the like. So let's start with giving us a brief background of yours, will you?
Well, Charlie, you did it better than I would. Just to add a little bit more sort of background information. As you mentioned, I grew up in Albania during the Cold War. This is when Albania was firmly within the socialist camp. And when the regime changed, which was after the fall of the Berlin Wall in 1990, I got an opportunity. I was very lucky to get a scholarship from Fresno State, of all places. And finally, a little background story on that. We got, actually, me and my friends, my high school friends, we got hold of this college books. I don't know if you've ever seen them, but they're sort of like, I think their title was The Complete Book of Colleges. So there's this big, thick books with all the addresses of all universities in the United States. And if you ever look at these books, I don't even think they exist anymore. I think they're now digital. But if you look at them, they're kind of sort of placed alphabetically by state. So you start with your Alabama and Arkansas and Arizona and Alaska and so on. And then you come to California. And California has many universities. By the time I came to California, so I started alphabetically. By the time I came to California, I ran out of postage money. I was actually writing letters to these schools telling them, I want to come to the United States to study, but I'm going to, please, but I don't have any money. My parents didn't have any money. No one really had any money. In Albania at the time, it was the regime, right?
Right, I'm sure.
So by the time I got to California, I ran out of money. So I'm very glad that Fresno State took pity on me as they actually offered me a scholarship. It was a fantastic opportunity. And I did a BA in economics, a minor in mathematics at Fresno State. I then applied to Columbia University. I got accepted, finished my PhD there. My areas of specialty are financial economics, kind of the cusp between macroeconomics and finance, sort of financial markets. I thought I was done with academia by then. I thought I would never go back to it, but little do you know, I actually joined Deutsche Bank as a senior economist. I worked in their FX research desk, and also in the economics group. This is the group that is responsible for economic forecasts of the bank. We actually put out forecasts for our clientele. I was in New York and in London, based in both places. And then a few years later, I made a transition back to academia. I came to Cal State Fullerton, where I teach economics. I teach financial economics. It's one of my areas. I'm also the co-director of the Wood Center for Economic Analysis and Forecasting, as you mentioned, and we do a lot of public speaking, sort of laying the outlook for the economy, the landscape, where we see it going. I'm also a consultant with the IHS Markit as well, which is one of the biggest consulting firms these days, getting bigger and bigger.
Well, it sounds like you stay plenty. Sounds like you stay plenty busy here, Mira.
I try. It keeps me out of trouble.
So, Mira, tell us, why did you choose a career in economics?
Well, as I mentioned, I came to economics in a bit of an unusual way. Usually, if I grew up in the U.S., I would have had exposure to the field at least in high school, perhaps even earlier. We didn't. I grew up in an Albania that was still under communist regime, socialist regime in my formative years, well until middle of high school. So we learned Marxism. So I never had any free market economy lectures. I actually, when the regime fell and I was still in high school, it was in my junior year of high school, the same lecturer that taught us Marxism started teaching free market economy. This is when so obviously they didn't go very well.
Right.
So when I came to Fresno State, originally my major was philosophy and sociology, but under the advice of one of my mentors at Cal State Fresno, I was told, give it a look, take an economics course, and I did. And I never looked back. I loved the course. I loved it because it sort of merges two things, my two sort of primary interests, which is it merges the exact sciences, which is mathematics, statistics, and so on, and also the social sciences and the business aspect of it. So it kind of performs a nice marriage of the two, and that's where that first economic course changed the course of my life.
Well, that's quite a story, especially given the fact you grew up in a communist country where it really didn't have economics as we know it, free market, etc.
Exactly. So I was learning the ABCs way after everybody who basically grew up in a completely different system, and sort of you seep it through osmosis. You seep it everywhere, and we never got that. And to me, it was sort of a light came on at that point. And,
that's great.
And I would never forget that.
Mira, I love to hear stories like yours because, for those of us who grew up here and we just take the whole place and everything for granted, it's inspiring to hear what you talk about and what you went through to get to the States and showing up with very limited resources. And your family didn't have resources. So congratulations to you for, this is bootstrapping at its finest here.
Oh no, thank you. But I have to say, I mean, I was lucky, number one, but also it's the system itself, right? It's the country that kind of gives you these opportunities, and I'm forever grateful for being here because I don't think I would get the same opportunities anywhere else in the world, and I mean it.
Well, we appreciate hearing that. So let's start at the 10,000-foot level here. What do you wish, as a PhD in economics and a professor and one who speaks on economics all the time, and I can tell everybody that was 1 hour that was absolutely filled with data and information that was applicable at the national level, the state level, the local level, etc. So what do you wish, Mira, that more people better understood about economics? What are the common misperceptions of economics that you wish weren't there to such a large degree?
Thank you for that question, Charlie, because I don't get asked that question very often, or almost never, which makes me think a little bit. There's a couple of things that I think people have to understand about economics that I think are sort of either misunderstood or there's a lack of knowledge. First of all, we all have to have an understanding that it's not an exact science. I mean, and that's perhaps what makes it fascinating, right? There are large standard errors around anything we say, anything we do in economics. When I present a forecast, there are standard errors around that number that I provide, obviously. And I think presenting and sort of preparing and presenting these forecasts for the school, and when I did it for Deutsche Bank, sort of taught me quite a bit to be basically don't be a great degree of humility, right? You could be wrong. There's large standard errors. This is one of the main lessons that I think people may get frustrated with economics because it's not an exact science. 2 and 2 does not exactly equal 4. There are standard errors around it. The second thing that I kind of notice is that not all issues, but some issues are big and complex, and they kind of require sort of a deeper understanding. It requires an explanation that goes beyond a tweet, goes beyond a hashtag, goes beyond a soundbite. And I think people get very sort of bogged down into getting just a highlight with one word or a couple of words, and that kind of does it injustice to a certain degree. And the third thing I would say, and I mentioned this a little earlier, is a little bit of a lack of misconception, a lack of knowledge about the economic realities. I give you a simple example. My own students, I always do this every time I have a class, and I start at the first class, I introduced myself in the course. I started asking them broad questions about just general global economy, right? Global facts. And I ask them, who's the biggest economy? The answer is China. Who's the biggest, U.S.'s biggest trading partner? The answer is China. In what country is the population growing faster? The answer is always China. So for everything it seems to, so obviously there is some misconception by the data. More broadly, if you go out there and talk to, and I love to talk to small business people, I love to talk to service people all day long, but there's a broad misconception about simple things like, how many people earn the minimum wage? The surveys show that the number is low. I mean, people's perception of who's earning the minimum wage is actually much larger than what the number is. People think it's 25 to 30%, when reality is about 3%.
Really?
If you ask them how big is it, well, what is inflation? Invariably, the answer is 8% to 10% or even 12%.
Yeah.
And of course, we can grapple about inflation and how you actually measure it, but it certainly is not 10%.
Right.
So there's this broad sense of misconception about or knowledge of data, I would say, that I find not only among my students but also just the broader public out there.
Hey, well, thanks for that input, because I think generally you're right. We live in a world of slogans and sound bites, and And we don't get a lot of hard data, and often that hard data is highly criticized, such as, the consumer price index and things like that. So let's move on for a second here, Mira. Tell us, we hear a lot about groupthink these days, both in corporations, on university campuses, etc. Is there one or more areas of economics where you find yourself differing in perception and perhaps belief or opinion from your peers or colleagues or many other economists?
So it's exactly what you mentioned. It's not a specific area. It's mostly in the approach. It is exactly that sort of herd mentality, that groupthink, that I think has seeped in. I see it more commonly observed more recently, last 5 to 10 years, than let's say 20 years ago. But it's certainly a pervasive feeling that I get. I mean, look, I'm a firm believer of what Mark Twain says, that when you find yourself on the side of the majority, it's time to pause and reflect. And I think I see, unfortunately, very little of that being done by my colleagues. And I'm speaking here for academia, but also those who work in the government, those who work for the Federal Reserve.
Okay.
I have a lot of my friends that work at the Fed, and it's almost like the moment they get a contract and they get a job at the Fed, they go from being critical thinkers. I mean, the Fed has done some good things. They've done some things that I disagree with, but they were critical thinkers to begin with, and you see them sort of like becoming cheerleaders almost overnight, and you sort of miss this critical assessment of the Fed policies. And in the same spectrum, in a way, and I think perhaps this is sort of following up on the same idea, is that more broadly there seems to be a lack of diversity of these ideas. If you were to map economic sort of thought processes last 20, 30, 40 years, right, you can actually you could map people out into sort of the economists into a following political spectrum. You have your liberals, you have your moderates, you sort of have your libertarian and conservatives. And what I see these days, especially with the young PhDs that are coming out every year, you see more of a convergence towards one thing, mostly the left or the center left in a way. And you've heard the saying, I always like to joke, you heard the saying that economists can't agree on anything. I think that was true for the old days. I think we're having too much agreement. I think we're not having enough disagreement these days. That's my concern. That sort of goes into your kind of dovetails exactly with what you were saying in terms of this groupthink idea, which kind of concerns me.
We'll come back to that in a minute here, Mira, but no question about it. We seem to. You watch CNBC, you watch Bloomberg News, you watch the Bloomberg Business, you watch CNN Business commentary, etc. and you hear the same thing over and over and over. They just don't even get broader. But before I get on my soapbox there, let's get through some more questions here. To get a little more granular, if someone were to ask you, what are the key economic indicators that we should be looking at to determine the next, year or so of the economy, what should we be looking at?
So I look at, for our own work at the Wood Center of Economic Analysis and Forecasting, and that's what we did also at Deutsche Bank, we looked at a number of sort of main statistics. And if I were to pick just a handful, I would say for the overall economy, probably the best indicator are non-farm payrolls, so sort of the changes on non-farm payrolls. They're usually, the problem with non-farm payrolls is that are not really a leading indicator necessarily. They're sort of, maybe they'll give you a sense 1 to 3 months ahead as to what's going to happen. For example, in terms of predicting a recession, their time lead to recession is about 1 to 3 months, maybe 4 months at the best of times. But another indicator that kind of helps inform our ideas as to where the non-farm payrolls are going, and luckily they're actually released on a weekly basis, is the unemployment claims. So to us, we keep a close eye on unemployment claims, sort of jobless claims, because they inform our thinking as to where the non-farm payrolls are going. The second overall broad indicator that I prefer is obviously the yield curve, even though the yield curve has had some issues since we've had this financial repression that was brought on by the Fed since the financial crisis. But the yield curve has historically been a very good predictor. We always keep a close look. And even though I don't think the yield curve is as good as a predictor has been in the past, it's still it's not completely useless. It still has its uses, and I keep a very close look at it. In terms of broader sort of subsectors of the economy, I keep a close look at the banks' tightening standards. This is basically a survey that is put together by the Federal Reserve. It's quarterly, unfortunately, so it's not very frequent. But it's the Fed Senior Loan Survey, where you basically identify stresses in the financial sector. How much are the banks' tightening standards when it comes to the commercial lending, especially for the small and medium-sized companies? I find historically that's a very good indicator for where we'll be heading into the next year or so. Another very good, of course, you have to keep an eye on the consumer, so consumer sentiment index is very important. And finally, in terms of sort of broader sectoral parts, the housing permits are a pretty good indicator, actually, with quite a good lead time, about 10 to 12 months, to tell us where we're headed over the next year or so.
Okay. Thank you very much. That was very, very helpful. And, it's the kind of things I've heard before, especially the first couple that you mentioned.
Right.
And
of course.
But that's important for us. Let me ask a question here. Labor participation rate. For political reasons, there are people who say, well, the unemployment rate is down, but our labor participation rate is so low. And I remember they said that, a couple of administrations back, that
right.
they hammered the current administration. Well, labor participation rate is so low, and you say the economy is so good, but why is it so low? Is that more economy driven, or is it driven by people's personal lives? And is that something we should even be paying attention to?
It is. So let me unpack that question sort of in steps. It is an important indicator about sort of where the middle class is going, sort of whether the income are growing. But more importantly, I'm not interested in the labor force participation as a sort of a broad measure, as a broad index. More importantly, I'm interested if you actually sort of split this down into subsectors by age group. I keep a close eye of those who are prime age workers. Those are the guys who should be at work working. This is the participation rate for those between 25 and 54 years old. And it has improved dramatically over the last, especially over the last 3 to 4 years. But we're still a little bit short, about 1.7 million short where we should be given demographic trends. And overall, though, the labor force participation is kind of capturing broader demographic trends. Look, it's going to be lower than it ever was because you have a lot of people retiring, right? You have baby boomers sort of retiring over time. So if you look at the broader number, I think it's less informative than if you narrow it down to this segment of population who ought to be working. And we're still a bit mystified why this 1.7 million, 1.8 million workers who are in the prime age, sort of the prime of their prime working career years, why aren't they in the labor force? If you ask them, there are surveys that are asked. The Atlanta Fed conducts a survey to figure out why they're actually staying out. And the large portion of that, much larger than it was historically, is due to disability benefits. And a bunch of others are things like staying home, basically taking care of family or going to school. Some of them are reentering school even though they're older than your common college students. But the large number was due to mostly to disability benefits, and I believe there was changes that has happened over the disability rolls over the years that had made getting these benefits a little easier. The current administration has taken some steps to actually reverse those trends, but we're still a long ways off.
Okay, well, we'll appreciate that. So let's move on a little bit here. A couple of very important issues here. Would love to get your input. If you were to give a grade to the Federal Reserve for what they've done over the past 10 years and what they're doing today, what would that grade be and why?
So my assessment...
We're putting you on the spot here, Mira.
I know.
CNBC doesn't ask that, okay?
Exactly. My assessment has actually, believe it or not, changed over the years. I think they did a decent job during the financial crisis basically in 2009, in March 2009, all the way, let's say, till June and so on. So when the financial crisis hit and they started sort of taking this extraordinary, unconventional monetary policy measures. But my assessment of that, so that was. We can quibble about whether they should have done to the extent that they did, but certainly something was needed when the financial markets were frozen up.
Yeah.
Beyond that, my own assessment is they quantitative easing ran amok. It lasted too long. It actually created misincentives. It created huge asset price misalignments.
Yeah.
Almost you would think asset price bubbles, and they became basically disconnected with sort of fundamentals. This is one of the biggest issues because obviously now that when they tried to drain that liquidity, which they started in 2015, 16, and 17, but they ramped up in 18, you saw what happened. The market tanked basically at the end of the last quarter of 2018.
Right, it did.
And in large part because of what the Fed was doing. So obviously now you have this almost kind of a strange reliance of the stock market in the Fed. And you wonder whether the stock market can even stand on its own, right? I mean, whether they have been fed too much of this liquidity. So I think, obviously I'd give them a failing grade for the intervening years since the Great Recession. I give them a bit of a break this year. Last year, I would say. I believe lowering interest rate last year was necessary because that's when they saw what would have happened had they continued in that path of tightening rates. But certainly, and now they're sort of in a better course of pausing interest rates. But certainly this has created a huge disconnect between fundamentals and asset price bubbles, obviously, and that's the biggest concern.
Yeah, and I would completely agree on everything you have just said here. And I would add to that is one, we've heard about those asset price bubbles for some time. Okay, I mean, people have been singing that tune for some time. But what I have found, because I have to do a lot of reading for this show and my clients, etc., and I have found just in the past few months many under-the-radar sounding alarms about the credit market, not just the assets the equity markets, but about the credit market, and that companies and especially institutions are now so hungry for yield that they are reaching to companies and governments, but especially companies who are borrowing money who couldn't have borrowed that money in the past. And so the credit markets have issues now that they haven't had, but they and the institutions are so hungry for yield, and almost any company can get a loan, and they're now calling them these zombie companies. And if anything happens, can they do anything about it? Your comments, please.
So I completely agree. Even my own research, my own academic research, actually deals exactly with this. I look at the two most common known tools of monetary policy, which is large-scale asset purchases and forward guidance. Right? That's the tools I've used all along during the crisis and beyond. And one thing that I find is that it's exactly this shift in terms of corporate financing, whereby, number one, the weakest companies issued more stocks. And the weakest companies also had broader access, bigger access to these credit markets. The problem is when things are going well, as we're living right now, sort of a Goldilocks economy, not too hot, not too cold. This is not it's a sort of these problems are sort of papered over.
Right.
My concern is when the next shock hits, and if it's an exogenous shock, obviously nobody would see. That's the reason why it's an exogenous shock. But if the next recession is due to an exogenous shock, or the next shoe to drop would be exactly these sort of zombie companies that are sort of over leveraged, but they're being able to get access to the capital markets and be able to get access to the credit market precisely because of the policies from the Fed. It creates this misaligned incentives, we shouldn't. But my answer has always been we shouldn't be surprised why they're acting the way they're acting. Right?
Yeah.
This is something we could certainly foresee.
Yeah.
I'm in complete agreement with you, and even the academic research bears this out.
Yeah, and it's scary, and we haven't been hearing a lot about that, and still don't hear a lot about it, but we hear more. So while we're on the subject of debt, we've got 4 areas of debt. Let me ask you, identify those 4, and you tell us which one or ones are you most concerned about. 1, the federal debt. It's only $22 trillion and growing daily. 2, the unfunded state and local government pension plans. And the world knows about this, but you wouldn't know that, okay? Number 3, as we've just talked about, the current record levels of corporate debt and the lack of quality of that debt. And right. 4, something that no one that I ever talk to understands, and that's zero or negative now interest rate policy. So which one of those 4 gorillas should we be most afraid of?
Right, the zero interest rate policy and the negative, the ZERP and the NERP, which sound like deadly viruses.
Yeah, they do, and they probably are.
They probably are. So let me just give you a broad answer that everything worries me, right? All of these ones that you mentioned worry me, but let me kind of rank them for you in a time horizon manner.
Please.
In terms of their urgency, I guess. Because I do think you are absolutely correct that you see less urgency about any of these areas. The federal debt. I mentioned this in my talk the other day, but we compiled a survey at the Wood Center for Economic Analysis and Forecasting, and we asked our local businessmen. We have 700 CEOs from local businesses to rank their concern. And one of the questions we ask, one of the options they can pick is the federal debt. And the latest survey, and this has been going on for a while, the latest survey, only 2% picked the federal debt as a big concern or as a big worry. So this sort of surprises us.
Oh, I'm shocked.
And I'm a little mystified myself. But I think the reason is more of a matter of urgency. When it comes to all these 4 risks that you listed, right? Yeah. I'm concerned, number 1, about current record levels of corporate debt for the next, currently, I think that's the biggest, more immediate risk. Because, again, if there is an exogenous shock to happen, let's say a coronavirus outbreak that is way worse than we thought. Again, this is not my baseline, but let's assume some scenario that is not thought out of very well, right? So that would be the first. I believe corporate debt is at the forefront of being very vulnerable. We've got $15 trillion in corporate debt. Basically almost $3 trillion of this is actually a very sort of iffy sort of debt, right? We've got $1.5 trillion in leveraged loans. You got $1.5 trillion on junk bonds. That's already the first shoe to drop if something bad were to happen. The second, so this is what worries me in the near term. I'm worried about the zero interest rate policy, precisely the ZIRP and the NERP, precisely when the next recession hit, which is likely going to happen. It's not our baseline for the next couple of years, but it's certainly going to happen between now and the middle of the decade. Right?
Business cycles happen, right? I mean, it's not anybody's fault necessarily. They occur.
And some things, and it would happen because eventually, by then, we're probably going to have some sort of a excessive debt building, not only in the corporate sector, but perhaps eventually for consumers, and so on and so forth. When expansions happen, debt levels tend to build up over time, and that's why you have these business cycles. And the problem with zero and negative interest rates policies, first of all, negative interest rate policies have been proven to be counterproductive. They've been adopted in Europe, and you see a lot of academic research that have thrown a lot of cold water on them, and I'm glad we haven't experimented. But even zero interest rate policy is worrisome because it doesn't allow you a lot of flexibility to deal. The Fed is out of ammo the next time the recession hits.
Yeah.
So I'm worried about that beyond the next couple of years. And then I'm more worried about government debt in the middle of the decade, and probably about underfunded state and local government pension plans. I worry about that all the time because I'm a government employee. So I'm worried that by the time my retirement will hit, there'll be nothing left for me. But that's actually, just joking aside, that's usually, I see that more as a ticking bomb in a 10-year horizon. I see the federal debt in a 5-year horizon.
Okay, well, we really appreciate, and that's what you said the other day when I heard you speak, and we really appreciate your contributions there. And my bet would be, if I were a betting person, which I'm not, my guess or bet would be that listing those four, most people would not have put, as you just did, corporate debt at the top.
No, I know, because I believe it's almost like a silent, sort of a silent risk that it's not in everybody's uppermost concern.
It's under the radar. So a question we like to ask all of our guests here, Mira, what keeps you awake at night?
Everything. I feel like as an economist and a forecaster, I joke, but it's true. I feel like I'm paid to be paranoid, which is a good thing, actually. But more specifically, look, I'll give you a sort of a short-term and a long-term answer for this as well, since I love time horizons. Short-term, I worry about, so over this year, I certainly worry about this election cycle. I think that's probably the most important risk to the U.S. economy. We've had elections come and go, and usually we tell people not to worry about them. They don't have a long-lasting impact. To the risk of saying this time seems to be a little bit different, and to the risk of sounding almost a bit apocalyptic, but I feel like things have changed in the sense that the candidates are more polarized, the electorate is more polarized, and I've never seen. I mean, usually in the past, yeah, sure, there are differences between the candidates running on both sides, but the differences were a lot more sort of minimized. And now you have sort of the far left on the Democratic Party, which is completely a new thing, in at least in American politics. And I feel like that by itself presents a big risk to financial markets. It presents a big risk to business investment, which are basically follow close to financial markets. And how that shapes up, it's sort of important. In the long term, to be honest, China worries me. China is a global power, but in a way it's an enigma, right? I mean, I know Churchill, what did Churchill say? He said, Russia is a riddle wrapped in a mystery, it's not an enigma. I feel like the same thing you can say about China these days. It's a completely different civilization with different sets of values. It's a mixture of sort of a state capitalism, it's an animal that's completely different from what we used in the past, what we used to see in the past historically. It's different from Soviet Union. We knew what we were dealing with the Soviet Union, right? So it was sort of a non-market-based economy. China is not that. It's a mixture of two. It's a global power that pretends it's a local power. It has global ambitions, but it pretends it doesn't. It's actually a developed economy. It's a middle-class economy, but it acts as a poor nation when it suits it. So, to me, that would be the challenges that we'll face going on over the next 50 years will be the role of China in the world and how we handle the role of China in the world.
A scary question. No question about it. There's plenty to keep you up at night, isn't there, Mira?
Yes, plenty. Yes, absolutely.
So, Mira, let's close with a little more positive note here. What book on investing for either investing or economics would you recommend for our listeners?
So the book is actually an economics book that I really liked. It's a book it's called Capitalism for the People by Luigi Zingalis, and he's at the Chicago Booth School of Business. And he does this great job at basically describing the American exceptionalism, which is based on free market economy. But it also has a stern warning about how the system has sort of almost changed, metamorphosis over time, where you have sort of politicians on both sides and big business turning the system more pro-business, in fact, pro-big business rather than pro-market, which are two separate things. And this certainly has given rise to populist movement you see in the U.S. and in the world, both in the left and in the right? So the worry is that, if this continues for too long, I mean, it's sort of if this system were to persist, who's going to be left to really speak up for the free market capitalism? And if you don't have the masses with you, sort of if they see the system as being corrupt, then all is sort of lost. And to me, it's sort of like a nice book that gives you a little bit of a warning sign that this is a great system, let's not lose it, and let's not let it go for so long that there is no recovery from the current trends.
So, Mira, thank you very much for that. Go over the title and the author again quickly.
So, Capitalism for the People, and the name of the author is Luigi Zingalis. He's at the Chicago Booth School of Business.
Okay, Zingalis, Z-I-N-G-A-L-E-S. Oh, Zingalis. Okay.
Zingalis.
Very good. Well, Mira, thank you so much. So before we sign off here, is there a website there for those who may be interested in learning more about or contacting you and learning more about the Wood Center, etc., that you could direct people to?
Sure, they can Google my name, Mira Farka, or you can type, and it's a little bit of a mouthful, but it's business.fullerton.edu/center/economic analysis and forecasting. So it's a little bit long, but it's easier to get. If you Google my name, it'll redirect you straight to the center.
Oh, okay. Great. And there's lots of information, I presume, on there. And
absolutely.
A way to contact you if they're looking for a speaker on economics or something, huh?
Absolutely, yes. And my contact information is there. We also put our reports there, our semi-annual reports, and our presentations, and our forecasting surveys are there as well.
Okay. Well, Mira, we are so grateful for your willingness to come on here today and offer you our best wishes for yours and the centers and your classes' continued success here. And let's all keep our fingers crossed that we don't have more things to keep you awake at night as we come along here. So thank you very much again for joining us. It's been delightful.
Thank you so much, Charlie. It's been a pleasure.
So again, we've been talking with Dr. Mira Farka, economics professor at Cal State Fullerton. You've been listening to Strategic Investor Radio on OC Talk Radio, where we bring you investment strategies you are not hearing elsewhere. And we'd love to hear from you. Info at strategicinvestorradio.com, and to visit our website to hear all of our podcasts and shows, strategicinvestorradio.com. I'm Charlie Wright, wishing you an enjoyable week and productive investing.
Strategic Investor Radio is a production of OC Talk Radio and is provided for educational purposes only. Content of this program and the views of the guests should not be considered as recommendations by OC Talk Radio or investment advice from the host Charlie Wright or any other entity attached to this production. Investors should always consult qualified financial, investment, tax, or legal professionals prior to investing.